Well, good morning, everybody, and welcome back to Strongman Personal Finance. We got a sponsored video. That's right. Somebody paid me, Daddy, Big Handsome, $50 to look at this interesting new stock that all the dividend DumDums in our dividends are putting their money into because there is nothing more important than dividends. So before we get into the stock and the sponsored video, I'm trying to stream this on Facebook, YouTube, and X, but I got a little notification here. A premium account on X is required to create live broadcast. I'm not paying for a freaking premium. Get out of here. What a grift. What a freaking grift. All right. So like I said, this is a sponsored video, and we're going to dive right into this amazing company. I haven't done any DD at all. I'm just going to give you my honest, heartfelt reaction to this interesting corporation. So we got Hercules Capital Incorporated, ticker symbol HTGC. It's got a market cap of $3 billion on trailing revenue of $504 million and net income of $256 million. Wow, that's some pretty heavy profits there. What's going on here? Okay. They got a dividend of 1.88, 11.26% yield. So right off the bat, what does that tell you? This is a high-yielding investment. And when the yield is super high, all the dividend clowns get interested because they believe this is your return. This is not your return, you clowns. You have to take the dividend, and then you have to plus the stock price appreciation or minus the stock depreciation. That's called total return. I know it's a very, very difficult concept for you. So this company has had a 16.87% year-to-date return negative, and that's partially because of the dividend, because the stock price drops by the amount of the dividend. So the total return is probably in the low negatives over the past year-to-date. Over the past year, it's down 16%, and over the past 5 years, it's up 38.7%. Now, what does Hercules do? Hercules. I'm basically Hercules. I mean, look at me. I'm Hercules' daddy. I'm Zeus. Hercules Capital is a business development company. The firm specializing in providing private equity, venture debt, and growth capital to privately held venture capital-backed companies at all stages of development, from mid-venture to expansion stage, including select publicly listed companies and select special opportunity companies that require additional capital to fund acquisitions, recapitalizations, and refinancing in established stage companies. Okay, so they're basically lending money. They're investing in / lending money to private equity, kind of opaque. I don't really know what's going on there. Do you? No. You want to know why? Because publicly traded companies have their information public. You can go on the SEC website. You can pull up the company. You can download their 10Q. You know, it's pretty transparent what's going on. Okay, I think it's a good thing to have financial transparency. With private equity or venture capital or growth capital, do you really know what's going on? No. Okay? What if there's a bubble in private equity? You would have no idea. How are you going to know what's going on? Who are these people? Who are they lending money to? Okay? Anyway, it's got a high dividend, so that's all that matters, bro. Okay? So that's the company. Let's go look at the financials. So revenue, they've been growing revenue, but it's all net interest, basically. Okay? So obviously, they lend money and they collect interest. Now, it looks all fine on paper. Like, look at all that income, bro. Look at all those profits, bro. Well, what if a huge issue comes down in the private equity markets? First of all, you can't even really tell because they're not publicly traded. When you look at the stock market and you see stocks go down in a vertical line, oh, something's going on. It's very transparent. It's very actionable. You can see what's going on, okay? You can quickly determine the fair value of a publicly traded equity just looking at market prices, okay? If you do private equity, if you're investing in private equity and the fundamentals start to collapse, how are you going to know? You're not going to know until it's too freaking late because there's no public market for it. Anyway, So they're generating a bunch of interest in income, which looks good on paper, right? You're getting all this interest. Oh my God. Like, imagine you have a hobo down the road, and the hobo, he's got a little issue with injectables, but every once in a while, he gets a little side job and he works construction or something. So he makes a little bit of money. So you look at this hobo and you're like, you know what, Mr. Hobo, I'm going to lend you money at 20% per year. Oh, no, a hobo, probably 50%. I'm going to lend you money at 50%. And the hobo's like, okay. So the hobo takes your money and he starts paying you, okay? Initially he starts to pay you. So you're getting that sweet 50% yield, bro. You're getting that sweet, delicious check, that interest. Oh my God, I'm getting so much money from the hobo. And, initially it looks great, all right? And then all of a sudden, the hobo, being a hobo, has a little relapse with his injectables. He goes a little bit too hard. Who's freaking messaging me? Who is this? Ugh. Anyway, the hobo goes a little bit too hard, and he relapses, and then he just doesn't work for 2 months. Oh, your money's gone. He's not going to pay you back, okay? So just because they're getting interest, bro, and it's growing. Who are they getting the interest from? How sustainable is the interest? What's the risk? Do you know the risk? You have no idea what the risk is, okay? Because you don't know what they're freaking investing in. And even if you do, how are you going to access their financials? Okay? Keep lending the hobo the money. Anyway, so they're generating interest income. Everything's great. Everything's wonderful. This thing will collapse in a freaking, depending on the risk of these companies that they're lending money to, this thing will utterly collapse in a bear market. I mean, it will just be like, you think stocks can go down? Oh my God. All right. So shares outstanding are increasing. So it looks like they're mostly generating, we'll see their debt situation, but they're definitely generating capital. So they'll issue shares on the market and then they'll take that money and they'll lend it out to private equity is what it looks like. So we see the share count ticking up. All right. Free cash flows all over the place. I mean, it's a lender. Okay. Let's see. Let's go look at their debt. I want to look at their balance sheet. So they have $53 million in cash and they have $4 billion in loans. Okay. So you can see they're definitely expanding their loan portfolio. Just loan. And then you get the interest and then you get the interest. Oh my God, we're winning. And then the economy collapses and then nobody pays your loans and then you collapse. Okay. So basically all of their assets are in loans and they have like a very small cash. And they're basically lending out almost all of their cash. Okay. Let's see. Long-term debt. So they got $2 billion of long-term debt. So they're obviously using a combination of debt and equity issuance to make loans. I mean, that's how a lender works, basically. Either you borrow money or you get money from investors, okay? Now, since retail is getting invested or interested in this stock, they should probably do more equity issuance because retail could pump the price like the morons they are. And then they could, they could get more capital that way. So they're using a combination of stock and debt issuance to get cash, and then they lend out the cash to private equity. Who? I don't know. All right. Cash flow. I mean, you got all this negative. I mean, it could just be like, lending money. Yep. Net change in loans held for sale. So the only way to judge this company is to understand the quality of the loans. The only way to really judge a bank, a lender, an investment company is to look at what they're investing in. That's the only way. I don't care about historic cash flows. I don't care about historic profits. Who are you lending money to? And is it sustainable? That's the question you have to ask yourself. So we could see that what they're doing is they're obviously borrowing some money, all right? They're borrowing money. They're also getting equity capital, and then they're paying this huge dividend. Why are they paying this dividend? It's to sucker in retail, okay? 11% returns. 11%. You think you're getting 11% from this? I don't know. I mean, let's look. Let's go look at the interest income again. So interest income, I mean, it's grown. It's definitely grown. But is the interest income keeping up with the dividend? Let's see. What's the earnings per share? So earnings per share is flat. Okay. It's basically flat. It hasn't gone anywhere. Free cash flow per share has been mostly negative. Okay. Profits are strong. Yeah, because they're just lending money. Okay. But it seems to be your earnings per share are flat. Your free cash flow per share is all over the freaking place. But overall, it doesn't seem to be growing that well. You would hope that free cash flow per share would grow. It's freaking declining. Earnings per share is basically flat. How is the dividend sustainable? How is the dividend sustainable? If you're lending money, how is the dividend sustainable? If your revenue's growing okay, I mean, it's kind of like really slowing down, and your earnings aren't really growing, and your free cash flow isn't really growing, how is the dividend sustainable? I don't think it is. But that's not even the biggest concern. The biggest concern is who's they're freaking lending money to. I mean, we could try to see. I don't even know. Do they even tell you? Okay, so I pulled up their balance sheet here. So as of June 30th, like I said, they had $4 billion in loans outstanding. And let's see. Okay, so they're getting mostly interest. This is like a it's basically like a high yield junk bond fund. That's all it is. I mean, that's what this is. It's like junk debt, okay? But at least with the junk debt ETF, you're getting like there's more transparency because they're probably investing in junk debt from publicly traded companies. Who are they giving money to? Oh, man. All right, I want to see if I can find who they're lending money to. That's the only thing that matters. All right, consolidated schedule of investments. Let's see. Is this it? Biotech tool. Path AI. What is this? What is Path AI? 9% interest. Aryaka Networks. Oh, yeah. We Incorporated. Altumland. Alutment. CarWow. Go Euro. House. Do you know what's going on with any of these companies? Shield AI. Saronic Technologies. So, what is this, dude? Look, this thing will utterly collapse. If the market goes to crap, if you see the stock market start to sell off, if you see the AI bubble pop, this thing is cooked, okay? Companies that are unprofitable venture companies are going to get absolutely collapsed if the market if the economy collapses in general, okay? These will fall more and have bigger financial issues than your standard large corporation that's publicly traded. Okay. It's called beta, but you can't even see it because it's under the surface. You don't know what any of these companies are doing. Are they making money? What is this? Veeam, Gibraltar Acquisition LLC. Look at the interest rates they're charging these companies. What do these rates tell you? These are high risk investments. Very high risk investments. And the interest may look good now, but if they can't pay their debts, your interest goes to zero. What is this? Oh my God. Look at these companies. Marathon Health, Chin Med LLC. Yeah, I got something to put on your chin. Vulcan Forms. Sight Sciences. Wow, I know these wow, man, I just got to trust their DD. Brain Corporation. Oh my God. Loftware Incorporated. This is so risky. Oh my God. There's no way you could understand what there is no way you could evaluate the like legitimately evaluate the risk of their portfolio. I think they're just taking money and just throwing it out to these random freaking venture capitals. Most of these companies will probably go bankrupt. I'll be perfectly honest. That's what I think. Okay. I think most of these companies are going to go freaking bankrupt. Now, if they go bankrupt, I'm sure Hercules can get some money, from the liquidation. But if the economy implodes, this thing is cooked. Done. How long has this thing been publicly traded for? Look at this collapse. So in 2020, right? It went from $15.99 all the way down to like $5. It lost 66% of its value. This is just a junk bond ETF. Basically, that's how you should look at this. So when it comes to this, if you think the economy's about to freaking implode, I would not touch this. If we go through a huge recession and you think the recession's about to bottom and rates are about to get cut, blah, 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 this could be like a speculative play. Okay? But if you think we're in a huge bubble and it's about to crash and you think the economy is about to implode, this thing is going to get annihilated. Okay? Don't worry about the stupid dividend. Stop focusing on the stupid dividend. Focus on the risk. What's the risk? The risk is they're lending money to highly speculative companies that you don't know anything about. Nobody's doing DD on this company. All they're doing is they're looking at the dividend. The dividend's really high. That's all they're doing. I guarantee it. Wow, private equity. That's the future, bro. Oh, yeah, 11% dividend. That's all they're doing. Swear to God, that's your only justification for buying this. You think I'm joking? That's what people are doing right now. You have no idea what's going on in this company. I have no idea. You think I have time to analyze all these freaking companies? Are they actually doing good due diligence, lending to these companies? Look at these interest rates. This is crazy. And they're buying stock. Okay, they got stock in Lyft. Okay, what's going on with Lyft? Is Lyft even doing well? They got some stock in Lyft. Okay, that's probably one of their better investments. Let's see. How's Lyft done? Oh, yeah, utterly collapsed. What else? Rhino Labs. Oh, Nerdy Incorporated. Is that publicly traded? Nerdy. Oh, look, they have stock in Nerdy Incorporated. Good pick, Hercules. What else? CarWow Limited. No. Job and Talent USA. Let's see. Opportune. Oh, another great pick by Hercules. Look at that. Losing money, of course. Let's see. Rhino Labs. No. Tectura Corporation. Tectura, I guess that's not publicly traded either. I'm trying to find many more publicly traded. Grove Collaborative. What is this? A communist stock? Grove. Okay, let's do Grove Collaborative. Oh, another penny stock. But the dividend, bro. They're buying cloud stocks. Look at this. What is this? Oh my God. Okay, I'm having fun with this now. Bicycle Therapeutics. Bicycle Therapeutics. Oh, only negative 242 billion of net income. Wow, good pick, Hercules. This is no, stay away from this. Rocket Pharmaceuticals. What a joke. What a freaking joke. Okay. Oh my God. Woo! All right, well, let's do some comments here. Okay, no members in the house this morning. That's freaking lame. All right, yeah, no, this company was a freaking disaster. Okay, it's all about the dividend. That's all these freaking clowns want to do. So people saying good morning. Elon keeps grifting. Are you holding lots of cash? I have 60K of treasuries because of self-employment. That's the only reason I have cash right now. If I was just going to stay at my W-2 for another 25 years, I would have almost no cash except for emergency savings, maybe like 10, 15K. I see no reason to sell if you don't need the money in 20 or 30 years. Drunk in the morning. Oh, yeah, I'm wasted, bro. I'm actually sick. My child got me sick. Okay. Well, hopefully this, I'm multi-streaming now, so hopefully this is doing okay. Hopefully it's interesting. But anyway, all right, thank you for tuning in. Now we're going to move on to the much more fun stream where we make fun of the stock market that's utterly collapsed. We do this last comment. I have a 40% total return this year with a 50% average yield and a 59% average yield on cost. I'm never going to be able to retire. If you're on, okay, you know what? I'm not even going to address that comment. You're cooked, dude. You're absolutely cooked. Anyway, like, subscribe, consider joining as a member to support the channel. Also consider booking a free 30-minute tax consultation. I am a certified public accountant and would gladly do your business and or personal taxes any state in the United States. You can talk to me for free. I give you upfront quotes, and I can prepare your taxes like a boss. Once again, this was a sponsored video. Somebody paid me $50 to react to this utterly clownish stock. And if you want a sponsored video, see the pinned comment in the YouTube video, and you can request a sponsored video. You send me $50, $45 if you're a member, and I'll react to whatever you want. Of course, I'll make sure it's YouTube appropriate, okay? Anyway, we'll see you in the next stream. Cheers.